In this video, we're going to look at how other interest rates will generally respond in response to a change in the cash rate. So generally what we refer to is the longer the term of the loan, generally the higher the interest rate, because banks generally compensate themselves for the increased risk of a longer loan and therefore will charge a higher interest rate. So first things first, the RBA only have control over the cash rate, and the extent to which an increase in the cash rate will flow on to other loans in the economy often depends on the amount of competition for funds. So what I mean by that is even if the RBA were to increase the cash rate, it doesn't necessarily mean other interest rates will increase, because other banks may not want to increase their rates because they need to maintain their profits and make sure that they're competitive with other banks. So other interest rates don't always pass on the rate increase or decrease. How interest rates are set. So any interest rate, anytime you get a loan, the interest rate that generally comprises of three things. One, the bank's cost of funding. So that might be their costs if they have deficits in their exchange settlement account, the cost that it funds them if they're borrowing from overseas, so they've got to cover their costs. If they don't have the money to meet your mortgage, essentially they have to borrow from overseas, so they need to charge you a rate that compensates them for what it costs them to get a loan. They also have part of it is a risk premium to compensate themselves for the riskiness of the loan being made. So for example, loans that have less collateral, which basically means the banks don't have any, if you can't pay it back, there's no way of the banks getting the money. So for example, a credit card loan has less collateral than like a housing loan, because a housing loan, if you default, they can get your house, where a credit card loan is not necessarily something they can get if you default. So there's generally a risk premium for any loan to compensate the banks for the riskiness of the loan being made. And that's why those with lower credit ratings will generally have to pay more for their mortgages. It's also increased since the GFC because particularly banks are less willing to lend because they've basically tightened up since the disasters of people not being able to pay back during the GFC. And there's also a markup on any loan you get so that the shareholders of the banks get a profit. So banks can actually make a profit above just the general, well, they want to make profits because they're greedy and because they're private businesses that are profit motivated as well. So their cost of funding needs to be covered, the risk premium in case some of their lenders don't pay them back, and then a markup for them to actually make a profit. During the GFC, the risk premium increased, and therefore so did the gap between the cash rate and the average mortgage. So what basically happened is the cash rate was still quite low, but the banks weren't passing that on because it was costing them more to basically get loans from overseas, because the overseas market became a little bit more stringent in terms of who they lent money to, and therefore they couldn't afford to lower actual interest rates too much on like mortgages and stuff. So how other interest rates generally respond to an increase or a tightening of monetary policy? First of all, there's less cash available, which leads to an increase in the cash rate. So the cash rate increases first. The cash rate is like a base rate upon which all other interest rates in the economy are founded. So if the RBA decides to increase the cash rate, there is upward pressure on commercial interest rates like home loans, business loans, credit cards, as the cost of obtaining credit for the banks will have risen. So if they have deficits, it's going to be costing them more, and therefore they're going to be passing that on to us in the form of higher interest rates so that they can compensate themselves for their higher production costs. So to maintain their profit margins, they need to raise their loan rates due to higher costs of production, particularly if they're running constant deficits in their exchange settlement accounts. Price of money close to cash. So what will happen when the cash rate increases? The price of money closest to the cash will also increase. So for example, what we're talking about there is really short-term loans will increase first. So you've got your cash rate, which is cash market, which is your overnight money market for lending. Then you've got things like bank bills and bank deposits, which are kind of like 30-day loans, particularly from banks to each other. They will be the second thing to increase. So the cash rate will increase, then your short-term loans will flow on. And then other interest rates will flow on from there and then on and so on and so forth. What can happen, because what happens if the cash rate increases by too much, and let's say a 30-day bank bill doesn't increase, what's going to happen is the banks are going to want to lend all their money overnight and then just roll that money over. So for example, if the cash rate was say at 3%, but the interest rate on bank bills or 30-day loans was only at 2.5%, what would happen is the bank, rather than offering 30-day loans, the bank would just keep rolling over one-day loans at a rate of 3%. So essentially there would be no market for bank bills unless the bank bill market margin was slightly higher than the cash market. So assuming there's no collateral on loans, the longer the loan, there has to be a higher interest rate. Otherwise the banks will just keep rolling over one-day loans and all lenders will just lend in the overnight money market. And then and as a borrower, if the cash rate was lower, you just keep borrowing money, and keep rolling over loans at the lower interest rate as well. So competitions for funds forces other interest rates to increase in line with the cash rate. Increases in the cash rate can be less effective if banks don't pass them on. That can be particularly the case if they want to keep people borrowing money from them. So when there was a time there when the RBA was increasing the cash rate, where other interest rates were staying pretty similar, and that's what we call a compression of lending margins. There was a smaller gap between the cash rate and the interest rate we were getting charged on loans because the RBA were increasing the cash rate, but these other loans were staying fairly similar or just increasing a little bit because there was more competition for loans. After the GFC, however, the RBA have been lowering the cash rate, but the banks haven't been passing it on. So if you did a graph, and I'll show you one of these in class, but the cash rate's kind of gone like this, where the other commercial interest rates have basically gone down, but at a slower rate. So let's say the other interest rates were here, it's kind of looked a little bit more like this. So the gap between the two has increased, and that's because the banks have been reluctant to pass on the loan cuts because it's costing them more to borrow from overseas because overseas markets are fearful since the GFC and are more reluctant to lend to people. So there's been a bigger gap between the actual cash rate and the rates on commercial interest rates since the GFC.